Hello, Accounting 101 students. In this video, we're going to go over stockholders' equity using our question 6 in our Chapter 11 end of chapter practice exercises. In this problem, we are given some information about the stockholders' equity accounts, and to make it a bit easier for us to go through this problem, I've included this information on the right side. Also, we are given some information about some transactions that happened during the period. And these are also included on the right side. In this question, we need to journalize the transactions, but before we do so, we're going to start by entering the beginning balances in the accounts. So we have all of these beginning balances on January 1st, and I already started us off here by including the balances on the credit side for preferred stock, common stock, paid-in capital in excess of par value, and the stated value for the preferred and common stock, and retained earnings. We don't have any cash dividends so far, and our treasury stock is reported on the debit side because this is a contra equity account. So now we're going to start off by recording the journal entries for each of these transactions. On February 1st, the company issued 4,600 shares of common stock for $27,600. So when the company issues the stock, we're going to debit cash for the amount of $27,600. We're going to credit our common stock account and our paid-in capital in excess of the stated value on the common stock. And the reason why I know it's the stated value is because when I look at the information provided in the data, we see that common stock has a $5 stated value. So to solve for this problem, I'm going to start off by including our common stock, which is going to be 4,600 shares times the $5 stated value. So this is going to report a credit of $23,000. Then I'm going to report the paid-in capital in excess by taking the dollar difference. So on the debit side, I have 27,600 minus 23,000, and that dollar difference of 4,600 is going to be on the credit side. And one of the things that you might want to do for a problem like this is to keep track of the common shares outstanding. So our common shares outstanding will start off with the number of shares that we have issued. And you'll notice that in this problem, we only know the shares authorized, but we don't know the number of shares issued. So we need to compute this by taking 1,204,000 and divide this by $5. So this will equal 240,800 shares. And now we realize that we have some treasury shares given to us in the problem. So I need to subtract out 4,550 for the treasury shares. And now we have issued an additional 4,600 shares. So as we go through the problem, we need to keep track of how many shares are issued and how many shares are outstanding. So on March 20th, the company purchased 1,800 additional shares of treasury stock at $8 a share. So in our problem, we're going to debit treasury stock and credit cash. And to come up with the dollar amount, we're going to take 1,800 shares times $8. So this will be $14,400. So I'm going to debit my treasury stock and credit cash for the repurchase of our own stock, and it's $14,400 on the debit and the credit side. Next, on October 1st, the company declared a 7% cash dividend on preferred stock. So every time we have a issuance or a declaration of preferred stock dividends, we're going to debit our cash dividends and credit dividends payable. And if I look ahead, I can see that on November 1st, we actually end up paying that dividends payable with cash. So now we have to come up with our dollar amount for the dividends payable. So to determine the dividends payable, we need to take the number of preferred shares. So we don't know the number of preferred shares, so we need to compute this. So preferred shares can be determined by taking the total dollar amount of $273,000, and we're going to divide that by our $100 par value. So now we know that we have 27,300 shares. So to come up with our dividend amount, we're going to take the number of shares, 23,300, and we're going to multiply that by the par value, 100. So you can see in this problem it ended up being 273,000. And we're going to then multiply this by the 7% rate. So this is the dividend rate, which will get you 19,110. So in our problem, we're going to include in 19,110 for our debits and our credits. And then now we're going to get to December 1st, where we're going to declare a 80-cent cash dividend to the common shareholders of record. So I need to take a moment here and I need to figure out how many shares do I have outstanding. So I was keeping track of my number of shares. So I needed to subtract out 1,800 for the additional treasury shares that we had repurchased on March 20th. And now I know that my total number of shares is 239,130 shares outstanding. So when I need to compute my dividend amount, I'm going to take my 239,130 shares and multiply that by 80 cents per share. And the number I'll arrive at is 191,240. And that's the amount I'm going to be using in my problem for the dividends. So on December 1st, I'm going to record my cash dividends and dividends payable. In the amount of 191,240. And then now I'm getting to year end. So at year end, I need to do a couple of things that are going to be a little bit different. On December 31st, we determined that the net income for the year was $278,800. And then we're going to note that they paid the dividend declared on December 1st. So there's a few things we need to do. The first thing, it guides us to record the net income. And you might remember from earlier in our semester, we need to close out the income summary, which is the net income from the year, to retained earnings. So we need to update our retained earnings as part of our closing process. So I'm going to include in the amount for retained earnings that is going to be increased due to the net income during the year. The next thing I need to do is close out all of my cash dividends to retained earnings. So my retained earnings is going to be reduced when I need to close out my cash dividends account to a $0 balance. And for the cash dividends, I need to look at all of the prior transactions and I need to add them together. So I'm going to take my cash dividends from October 1st and my cash dividends from December 1st, and I need to add them together, and I'll get $210,350 when I add the two transactions with the cash dividends together. Last, I need to record the payment of the cash dividends payable. So this journal entry is going to be the same as the November 1st entry, where I'm going to debit dividends payable and credit cash. So I'm going to pause here and scroll down for everyone to see all of these notes. So we have our dividends payable and cash, and we want to pay these dividends right here for $191,240. And once you've recorded the journal entries, you will want to go ahead and record all of these into the T account. So you're going to enter in the beginning balances and post the journal entries to the stockholders' equity accounts. And you will go ahead and go through line by line with our journal entries and make sure that you've included in all of these amounts. If you'd like to pause the video just to make sure that you have time to do all of these, if you want to look up whether the balance belongs on the debit or credit side, I recommend doing so. And here are the rest of the transactions that were posted into our T accounts, so that way at the end of the period we have our updated amounts in the general ledger, which will be used to put together the trial balance, which we then will use to put together the stockholders' equity section on the balance sheet. So you'll notice that retained earnings is increased by net income and decreased by the dividends. The cash dividends are reported as debits, and in that closing entry, we record a credit to close it out, and our treasury stock always stays on the debit side. So now we have our partial balance sheet, and in this partial balance sheet, we start off with stockholders' equity, and we include in the paid-in capital, which has preferred stock and common stock. And then we have a section for the additional paid-in capital, which has the paid-in capital in excess of the par or stated value to get our total paid-in capital. Then we need to include our amount from retained earnings, and that's the reason why we need to update our retained earnings to get our total paid-in capital and retained earnings. Treasury stock is subtracted at the very bottom of this partial balance sheet in order to get to our total stockholders' equity. Then we need to compute a few ratios. For the payout ratio, you're going to look at the cash dividends paid on the common stock and divide that by your net income. For earnings per share, you're going to take your net income, subtract out your preferred dividends. So now we have an example with preferred dividends divided by the average number of shares outstanding, and the return on common stockholders' equity will be similar, only now you're going to look at the dollar amount of the common stockholders' equity that is outstanding, and it's going to be the average. So thank you for taking the time for watching this video. Please pause as you need to, as this was a lot of information in one problem.